When a country goes bankrupt, it is known as a sovereign default, a situation far more complex than an individual declaring bankruptcy. Unlike a person who can liquidate assets or seek protection under bankruptcy laws, a nation's obligations are intertwined with its economy, political system, and international relationships. Sovereign bankruptcy occurs when a government can no longer meet its debt obligations, meaning it cannot pay back loans or interest to creditors. This can happen due to excessive borrowing, poor fiscal management, economic shocks, or political instability. The consequences are severe. The country may face economic collapse, hyperinflation, and loss of investor confidence, while its citizens experience rising unemployment and poverty. Social unrest often follows, as people protest against austerity measures and deteriorating living conditions. Internationally, a default can ripple through global markets, affecting trade partners and investors. Historical examples, such as Argentina in 2001 or Greece during the European debt crisis, show how devastating and far-reaching sovereign bankruptcy can be, reshaping a nation's trajectory. A country can go bankrupt for several interconnected reasons, often combining poor economic planning, external shocks, and political instability. One of the most common causes is excessive debt accumulation. Governments often borrow heavily to fund development projects, social programs, or military expenditures. While borrowing can stimulate growth in the short term, taking on debt beyond sustainable limits becomes dangerous. As interest payments increase, the government may struggle to meet both principal and interest obligations, pushing the country toward insolvency. Poor fiscal management also plays a crucial role. Mismanagement of budgets, widespread corruption, and inefficient taxation systems can drain public resources and prevent governments from generating the revenue needed to service debt. Without prudent financial policies, even moderate borrowing can spiral into a crisis. Economic shocks further exacerbate the problem. Sudden collapses in commodity prices, disruptions in trade, or global recessions can reduce national income and limit access to international credit. Countries heavily reliant on exports are particularly vulnerable to such shocks, which can quickly undermine their ability to meet obligations. Political instability compounds these challenges. Frequent leadership changes, civil unrest, or armed conflict reduce investor confidence and can lead to capital flight, further weakening the economy. When these factors converge, a nation's financial position deteriorates rapidly, setting the stage for a sovereign default that can have devastating social, economic, and political consequences. When a country declares bankruptcy, the immediate economic consequences can be severe and far-reaching, affecting both the national economy and individual citizens. One of the first and most visible impacts is currency devaluation. As investors lose confidence in the government's ability to manage debt, demand for the national currency drops sharply, causing its value to plummet. A weaker currency makes imports more expensive, leading to rising prices for everyday goods and triggering inflation that erodes citizens' purchasing power. The banking sector is often one of the hardest hit. Banks rely on public confidence to operate effectively, and in the wake of bankruptcy, depositors may rush to withdraw their savings. This can result in bank failures, freezing of accounts, and a collapse of the financial system, leaving both individuals and businesses vulnerable. Governments may attempt to respond by printing more money to cover deficits, but this can create hyperinflation, where prices rise uncontrollably, savings lose value, and economic stability is further undermined. Simultaneously, unemployment surges as both public and private sector organizations cut costs to survive the economic contraction. Businesses may close or downsize, and government layoffs may become widespread. These combined factors create a vicious cycle. Economic instability reduces consumer spending, which further weakens businesses, deepens unemployment, and intensifies the financial crisis. The immediate fallout of bankruptcy, therefore, affects every sector of the economy and sets the stage for long-term challenges in recovery. The social and human impact of a country going bankrupt is often devastating, affecting millions of lives in profound ways. One of the most immediate effects is rising poverty. As the economy collapses, citizens lose their savings, wages decline in real terms due to inflation, and essential goods become increasingly unaffordable. Families struggle to meet basic needs, and large segments of the population can be pushed below the poverty line. Food and medicine shortages frequently accompany these crises. With limited government resources and a weakened currency, importing essential supplies becomes nearly impossible, leading to malnutrition, deteriorating public health, and increased mortality rates, particularly among vulnerable populations. Social unrest and protests often follow. Frustrated citizens take to the streets to express anger over poor governance, corruption, and economic mismanagement. Demonstrations can escalate into violent clashes with authorities, further destabilizing the nation. Additionally, migration waves may occur as people seek safety, stability, and better opportunities abroad. Skilled workers, professionals, and entire families may leave the country, resulting in a brain drain that further weakens the economy and hinders recovery. The human cost of bankruptcy is immense, transforming economic failures into widespread suffering and long-term societal challenges. The political consequences of a country going bankrupt can be as severe as the economic fallout, fundamentally altering governance and international relations. One of the most immediate effects is the loss of public trust. Citizens lose faith in government institutions, perceiving leaders as incompetent or corrupt, which can lead to political instability, protests, and challenges to authority. International relations also become strained. Creditors, foreign governments, and international organizations may impose sanctions, restrict lending, or demand strict oversight as conditions for financial assistance. These measures can limit a country's sovereignty and complicate diplomatic relations, further isolating it on the global stage. Domestically, governments are often forced to implement drastic policy shifts. Austerity measures may be introduced to reduce deficits, which can include cutting public spending, increasing taxes, and reducing social services. Alternatively, countries may seek external bailouts from institutions like the International Monetary Fund, often requiring painful economic reforms. These political consequences shape both the short-term response and the long-term trajectory of a nation recovering from bankruptcy. The bankruptcy of a country rarely remains confined within its borders. Its effects ripple across the global economy. One immediate consequence is investor panic. International markets react swiftly to news of a sovereign default, causing stock prices to plummet, interest rates to fluctuate, and investment portfolios to lose value. Global investors may withdraw funds from other emerging markets perceived as risky, amplifying financial instability. Trade disruptions are another significant impact. Countries that rely on exports to the bankrupt nation may face unpaid debts, while imports of essential goods become scarce, affecting supply chains and creating economic strain worldwide. The contagion effect can further spread financial instability. Neighboring countries or nations with similar economic vulnerabilities may experience capital flight, currency devaluation, or rising borrowing costs as investors fear a regional or systemic crisis. In this way, the bankruptcy of a single country can trigger a chain reaction, affecting economies, markets, and societies far beyond its own borders. Recovering from a country's bankruptcy requires a combination of strategic financial measures, international assistance, and long-term economic reforms. One of the first steps is debt restructuring. Governments negotiate with creditors to extend payment terms, reduce interest rates, or even partially write off debts. These negotiations help ease immediate financial pressure and create a more manageable repayment schedule, allowing the nation to stabilize its economy. International bailouts are another crucial tool. Organizations like the International Monetary Fund, the World Bank, or allied countries may provide financial assistance, often accompanied by guidance and oversight. While these bailouts offer much-needed liquidity, they usually require implementing strict economic reforms. Economic reforms play a vital role in long-term recovery. Governments must introduce fiscal discipline, reduce corruption, improve taxation systems, and create an environment that incentivizes domestic and foreign investment. Finally, diversification is essential to strengthen economic resilience. By developing domestic industries, reducing reliance on imports, and supporting multiple sectors, countries can mitigate the risks of future shocks and prevent repeating the mistakes that led to bankruptcy. Together, these strategies provide a roadmap for restoring stability and fostering sustainable growth. History offers valuable lessons on the consequences of sovereign bankruptcy and the paths to recovery. Argentina's 2001 default was triggered by excessive borrowing, rigid currency policies, and economic mismanagement. The country faced massive unemployment, social unrest, and a sharp devaluation of its currency. Recovery involved debt restructuring, economic reforms, and gradual rebuilding of investor confidence. Greece's debt crisis in 2010 highlighted the dangers of high government spending, weak fiscal oversight, and structural inefficiencies within the economy. The country relied heavily on international bailouts from the European Union and the International Monetary Fund, implementing severe austerity measures to stabilize public finances. Zimbabwe's hyperinflation crisis in 2008, fueled by excessive money printing and political instability, decimated savings and caused widespread poverty. Its recovery required abandoning the local currency in favor of foreign currencies, restoring fiscal discipline, and rebuilding agricultural and industrial sectors. These examples emphasize the importance of prudent fiscal management, political stability, and early intervention to prevent economic collapse and safeguard citizens' well-being. Sovereign bankruptcy sets off a chain reaction that extends far beyond the nation's borders. Economic collapse leads to currency devaluation, banking failures, hyperinflation, and soaring unemployment, while social consequences include rising poverty, shortages of essential goods, protests, and mass migration. Politically, public trust erodes, governments face pressure to implement austerity measures, and international relations are strained. Globally, investor panic, trade disruptions, and contagion effects can destabilize other economies, highlighting the interconnected nature of today's financial systems. Avoiding such crises requires a commitment to fiscal responsibility, transparent governance, and prudent debt management. Countries must prioritize sustainable economic policies, maintain political stability, and foster strong institutions that inspire confidence domestically and internationally. Additionally, international cooperation through financial oversight, development programs, and emergency support can mitigate risks. By learning from history and implementing proactive measures, nations can safeguard their economies, protect citizens' livelihoods, and prevent the devastating ripple effects of bankruptcy.